If you've got a retirement account, or really if you've ever even thought about investing, you've definitely bumped into the world of investment companies. These things are an absolutely massive force in finance, but how they actually work, well, that can feel like a total black box. So let's dive in and pull back the curtain on what's really going on. And just to give you a sense of the sheer scale we're talking about, look at this number, $12 trillion with a T. That's how much money these companies were managing back in 2009. And get this, that number had basically quadrupled in just 14 years. To put that into perspective, that was almost as much as the value of every single stock on the NASDAQ and the New York Stock Exchange combined. It's just a staggering amount of money. So, okay, that leads to the big question, right? What exactly are these financial giants? How on earth do they take money from millions of regular people and spin it into these massive, diversified portfolios? Well, that's what we're here to do. We're going to break it all down, piece by piece, starting with the granddaddy of them all, the mutual fund. All right, first up, let's get into the absolute foundation of this whole world. We're talking about open-end mutual funds. Honestly, for most people, when you hear the term mutual fund, this is exactly what you're picturing. And for good reason. They are, by a long shot, the most common way people invest in these kinds of companies. The core idea here is actually brilliantly simple. A mutual fund just pools money. It takes cash from thousands of smaller investors, people like you and me, and creates this one giant pot of money. Then it uses that big pool to go out and buy a whole bunch of different stocks, bonds, or other assets. And the magic of that is it gives everyday folks access to two really crucial things: professional management and, maybe even more importantly, diversification. I mean, the kind of diversification that would be basically impossible to get on your own. But that brings up a really good question, right? I mean, if a fund owns hundreds of different stocks and all of their prices are zipping up and down every single second, how do you figure out what one share of the fund is actually worth? Well, the answer has a name. It's called net asset value, or just NAV for short. And the way you calculate it is surprisingly simple. You can see it right here. First, you just add up the market value of every single thing the fund owns, all the stocks, bonds, cash, everything. Then you subtract any liabilities, like management fees. That gives you the fund's net assets. That's its true bottom line worth. And for the final step, you just divide that big number by how many shares are out there. Boom. In this little example, you get a net asset value, a NAV of $17.90 per share. Okay, so here's the really crucial takeaway. For an open-end mutual fund, the NAV is the price, period. This whole calculation happens just once a day right after the stock market closes. So if you want to buy shares, you buy them directly from the fund at that day's NAV. And if you want to sell, the fund buys them back from you at the NAV. It's a closed loop, a direct transaction with the fund itself. But what if you couldn't sell your shares back to the fund? What happens then? Well, that simple question leads us to a totally different kind of structure, the closed-end fund. And this is where we get into a really fascinating, long-standing puzzle in the world of finance. So here is the single biggest difference between the two, and it's super important. With an open-end fund, remember, the fund itself creates new shares for buyers and gets rid of shares for sellers. The number of shares changes every day. But with a closed-end fund, nope, they issue a fixed number of shares just one time, at the very beginning, and that's it. From then on, if you want to buy or sell, you have to go find another investor on a stock exchange who's willing to trade with you. And that is where the puzzle really starts. Because these closed-end funds trade on the open market, their price isn't tied to the NAV anymore. It's set by plain old supply and demand, just like shares of Apple or Ford. And what that means is that the market price, well, it can, and it very often does, drift away from the actual value of the assets inside the fund. This creates a weird situation where a fund can trade at a discount or a premium to its real worth. And this example just illustrates the point perfectly. Take a look at the First Opportunity Fund. The actual stuff it owned, the stocks and bonds inside, was worth $7.92 per share. That's its NAV. But on the stock market, you could buy a share for just $6.01. That is a huge 24% discount. Think about that. You were literally buying $1 worth of assets for about 76 cents. Now, the risk, of course, is that the discount might just keep getting bigger. So this whole discount puzzle was a major headache for closed-end funds for decades. But then, in the 1990s, a brand new invention came along that was designed to solve this exact problem.
It's called the Exchange Traded Fund, or ETF. And the whole idea was to get the best of both worlds, the ED trading of a closed-end fund with the stable pricing of an open-end fund.
So how did they do it? How in the world do ETFs manage to trade on a stock exchange all day long, yet their price almost never strays from their net asset value? Well, the secret sauce is a really unique and frankly clever mechanism called arbitrage. Yeah, it all boils down to this special feature for creation and redemption. This is the key difference that separates ETFs from those older closed-end funds, and it's what keeps their market price right where it should be.
Okay, so check this out. Here's how it works. Let's say an ETF's price on the stock market starts to drift a little higher than its actual NAV. While these huge financial institutions, they're called authorized participants, they see that gap as a risk-free profit. So what do? They go out and buy up the actual stocks that the ETF is supposed to hold. Then they take that whole basket of stocks and they trade it to the ETF in exchange for brand new ETF shares. And then, step 4, they immediately sell those newly created, slightly overpriced ETF shares on the market for a small profit. All of that selling creates pressure that pushes the ETF's price right back down to where it belongs, in line with its NAV. And this whole thing works in reverse if the ETF ever trades at a discount. It's a self-correcting system.
So did it work? Yeah, you could say that. Just look at this growth. In 1995, there was about $1 billion in ETFs. By 2009, nearly $800 billion. That kind of explosive growth tells you everything you need to know about how popular and effective this new invention turned out to be. So why did ETFs get so popular so fast? Well, it really comes down to a few killer advantages. First, you can trade them all day long, just like a regular stock. You can also do more advanced things like sell them short, which is basically a way to bet that the market's going to go down. On top of all that, they often have rock-bottom fees and are structured to be really tax efficient. You put all that together and you got a seriously powerful tool for investors.
Okay, so open-end funds, closed-end funds, and ETFs. Those are definitely the big three. But the universe of investment companies is actually even bigger than that. So let's just take a quick peek at a couple of other specialized players in this game. All right, first up, you've probably heard of these. Hedge funds. Now, unlike mutual funds, these are private clubs. They're only open to what are called accredited investors, which is just a fancy government term for people with a really high net worth or income. Because they're private, they can play by different rules. They can use a ton of leverage, which means borrowing money to try and juice the returns, and they can aggressively bet against stocks. They're also famous for their 2 and 20 fee structure. That means they typically charge 2% of your money every year just for managing it. Plus, they take a 20% cut of any profits they make. It is definitely a high-risk, high-reward game, really designed for a very specific kind of wealthy, sophisticated investor.
And then we have something called real estate investment trusts, or REITs for short. The easiest way to think about these is like a mutual fund, but for real estate. A REIT is just a company that owns, operates, or finances buildings that produce income. They let anyone invest in a big portfolio of properties. We're talking office buildings, shopping malls, apartment complexes, you name it. Most of them, called equity REITs, actually own the buildings and make money from rent. Others, called mortgage REITs, invest in the mortgages on those properties instead. Now, here's the cool part. By law, REITs have to pay out at least 90% of their taxable income to their shareholders as dividends. And as you can see from this chart, that can lead to some really powerful returns. But it also means they can be super volatile, riding the wild ups and downs of the real estate market. So, there you have it. We've walked through the classic mutual fund, we've dug into the weird puzzle of the closed-end fund, and we've seen the elegant solution that ETFs brought to the table. Each one of them has a totally different structure, its own set of pros, and its own set of cons. At the end of the day, the real question is, for you, now that you know the mechanics behind the curtain, which one of these powerful tools makes the most sense for what you're trying to accomplish with your money?